Okay, Matt, I think you can go ahead and start.
All right, proceed with our next slide. So we're actually going to practice reading the ticker tape right here. So can anybody just like spit out in the chat, what does the MSFT indicate? What does that mean? Can someone just share
I
in
was
the
searching
chat?
it up. I can't stop you, but
Okay, perfect. So MSFT basically it represents the ticker symbol, which is the unique characters used to identify the company. So in this case, it is obviously Apple. No, I'm just kidding. It's Microsoft. Um, anyways, can anyone tell me what the 5K means? Which is our next thing. Right. Is it Ritika? Okay, Ritika Gupta. That is correct. So the 5K basically represents the shares traded. So in other words, the volume for the trade being quoted. So when we look at a ticker tape and you see a 5K, the K represents 1,000, but sometimes it'll actually have an M or B, which stands for million or billion. In this case, it's 5,000. Can anybody tell me what the 61.25 means? Right.
The price.
61.25 is the price traded, which is the price per share for stock. In this case, it's 61.25 on the last bid. And can somebody, this is pretty easy, but can somebody tell me what the next one is?
Percentage, like.
The last one, but right now we're looking at the arrow, which basically
Okay.
stock is trading. So this indicates a falling price. And as you can see, this entire ticker is red, which indicates a falling price. And of course, the last one is the change amount, which represents the difference in price from the previous day's close. So in most usual cases, they'll also show the percentages as well. But in this case, it just shows that the company fell 1.35. So also, before we move on to our next slide, just remember that it can be nearly impossible to see the exact price and volume at the precise moment that the stock is being traded. So think of like the ticker tape as providing you with a general picture of the current activity of the stock.
All right, so let's take a moment to talk about dividends. So a dividend is the distribution of some of a company's earnings to a certain class of its shareholder, and that value is determined by the company's board of directors. So initially, whenever dividends are assigned, they must be approved by the shareholders through whatever voting rights that they have. The board of directors can then choose to issue dividends over various timeframes and with different payout rates, depending on how much an investor has put into it. So essentially, these are sort of an incentive for people to buy the stock because they will be rewarded with a dividend later on.
yeah, I know this is hilarious, right, Joey?
That is my bad.
Continue, Anish.
All right. So announcements of dividend payments are generally accompanied with, depending on how much the dividends have increased or decreased, that will affect the company's stock price as well. So there are some companies that there are certain industry sectors that have maintain a record of regular dividend payments. So depending on the company, there's no fixed value. It's not like every company has a stock. Dividends aren't like that. So only certain companies have it, but there are a few that seem to have regularly occurring dividend payouts than others. So some of these would be oil and gas, financial institutions, healthcare and pharmaceutical companies, along with utilities. So those are companies that you would traditionally see them having a regular payout to their investors and shareholders. So a dividend, so that's sort of all there is about dividend. So bonds are the amount of money, or is when a company puts itself into debt to the people. So it's sort of a glorified loan. So the way it works is that the owners of a company will sort of sell parts of their companies back out to the public. It's similar to like a credit card. So the people are lending the company money with the assumption that the company will pay it back later. And the longer that they do not pay that money back, the more interest that sort of accumulates with it. So certain key elements to think about when looking at bonds are its face value. So the face value of a bond is the current value at that moment in time. The maturity of a bond is the date the amount of debt should be paid back with all of the interest included. And of course, rate is just the annual interest rate. And the interest rate on the day that the bond is issued is known as coupon rate. That's something to keep in mind. Credit risk is the risk of the issuer defaulting. So the risk that the company from which you got the bond from will not be able to pay it back at a certain rate. It's very low risk, very low reward, but it's stable. So people often look at this as a way of sort of boosting their income, fixed income. That's the way many people look at this.
All right, so there are two main types of bonds. Does anyone want to take a guess on what those two types are? Just put it in chat.
Or you can unmute yourself.
Guesses? Anything?
And if you can't think of two, it's okay if you guys just want to suggest one too.
All right, Derry.
Well, when you think of bonds, what do you usually think of? Yeah, very good, Gavin. And yeah, I can see a lot of you talking about the government in general, Treasury. Yeah.
Right, so there are two main types of bonds, like Cassie just said, government and corporate. So for government bonds, we'll be talking in terms of the US government, although obviously governments around the world have offered their own types of bonds. So anyways, within our government, there are four types: bills, notes, bonds, and Treasury inflation protected securities, or TIPS for short. Notes, or bills, or commonly referred to as T-bills, last the shortest of the bunch, anywhere from a few weeks up to a year, and they actually have the lowest interest rate earned on them because, well, they're the lowest risk. I'll get into why that is in a little bit. Notes last anywhere from 2 to 10 years, and bonds last anywhere from 20 to 30 years. So thus, they actually have the highest interest rate on the bonds because they are exposed to the most risk. Again, I'll go over that in a little bit. Actually, I'll go over that right now. Why not? So the reason that the Treasury bonds have the highest interest rate paid on the bond itself is because over time, you are exposed to more risk. Like, we don't know what may happen in 10, 20 years. Maybe there's a world war. Maybe the economy collapses. Something like that happens, and suddenly the US can't afford to pay the bill, and this is the bill in this case. So in that case, because you're exposed to more risk, the government actually raises interest rates to incentivize investors to buy it. And finally, we have TIPS. And what makes them special is, as you guessed, is that they provide protection against inflation. So inflation, and we'll talk about inflation in a later meeting, I'm sure, is basically over time, money actually loses value. So we express how much it loses value by the inflation rate. And currently it's around 2%, just for context. So Treasury notes and bonds are actually backed by the full faith and credit of the US Treasury, so there is virtually no risk of default. They are considered the safest investment in terms of bonds in the US. So currently the US 30-year has a yield of 1.4%, which is actually really, really low, because if you take into account inflation, which is around 2%, you'll actually lose money on the bond. And that may seem really confusing, but just think about it like this. The money you get back from that bond, from just placing the money you get back from investing into that bond is going to be worth less in the future than it is now. And the value at which it's worth less will basically means that you lost money. So on the other flip side, we have corporate bonds. So companies typically issue bonds as an alternative to selling stock in order to raise capital, which goes towards purchasing like new factories, machines, supplies, all those kinds of things. Now, the important distinction between the two are the risk and the reward. Because corporate bonds aren't guaranteed by the federal government like Treasury bonds are, they are inherently riskier. So in order to reflect this risk, corporate bonds actually have a higher coupon rate in order to incentivize investors to buy that bond. So let's take a look at a Tesla bond. So this Tesla bond was issued in 2017 and has a maturity date in 2025, as you can tell. So when it was issued, it had a value of $100, which is pretty normal. And the coupon rate was 5.3%, which, as you can see, is about 4 to 5 times higher than the US Treasury yield is, Treasury yield is right now. However, now in 2020, the yield has actually gone down because the value of the bond has increased. And that may seem a little backwards, but again, it's because the coupon rate stays consistent regardless of the value. So the yield is actually going to be the coupon rate adjusted for the value. And because the value went up, the yield is actually going down. Yeah.
So before we move on, Ronak, he explained everything really well, but it's a little bit of a complex concept. So before we move on, let's do a little experiment. Wait, Aryan. So you'll be the subject of our experiment, okay? Aryan, pretend you have $1,000 and then you're choosing to lend it to either Audie or Joey. Okay, and let's say Joey's really good about his money. He always pays people back. Yeah, I don't know how that is in real life. But no, actually in real life, people always have to pay Joey back. But for Audie, let's say Audie, he's not so good about his money. Maybe he goes and gambles away his money or loses it in stocks or something like Tesla, which is like, it fluctuates a lot. So maybe he's not so stable. Who would you just naturally want to loan your money to? Which one?
Joey.
Yeah, Joey, because he's safer, right?
Yeah.
Mm-hmm. Okay, so what would Audie have to do to make you want to loan your money to Audie instead?
You'd have to change or like buy me a car or something like that. But there has to be some sort of difference in what he's done.
Yeah, exactly. He has to incentivize you somehow. So the way that these the government or corporations do this, as Ronak was saying, was to basically increase the interest rate. So he says the only reason why you would lend money to them to begin with is maybe they're your good friend, or like more realistically speaking, they'll pay you back some extra. That's the interest, right? And so you obviously want to be paid back more than less. So like if Joe is going to pay you back the money plus like maybe $5, but then like, you know, Audie's here, maybe he's risky, but maybe he's also kind of loaded. So he pays you back like the money, but also like $5,000 extra dollars. That would never happen in real life, guys. But like maybe he pays you back a ton of interest. Then who would you want to lend your money to?
Well, obviously, if the money like wasn't really that important, then I'd give it to Audie, because the like prospect for profit is more.
Yeah, exactly, because you can afford to take risks.
All right, now let's talk about some of the advantages and disadvantages of bonds. So advantages, a bond is a relatively secure investment that inherently carries low risk compared to stocks. If you're wondering why, it's because bonds carry the promise of the issuer to return the face value, or basically the principal, of the bond to the holder at maturity date, and most bonds pay investors at a fixed rate of interest income that is also backed by a promise from the issuer to pay back that interest. Another advantage is that in a typical loan, you would owe the lender or bank money and interest, but in this case, it's actually the other way around. And now you become the lender and they become the borrower, and now they owe you money and interest. Finally, in the case of defaults, which is when the borrower fails to pay back a loan, the company's assets actually go to the bondholders first, even before preferred stock owners, like Colleen mentioned. And if you're wondering why, if you and I were to take a loan for, let's say, a car, and we defaulted on it, which means we failed to pay back that loan, the lender is actually entitled to repossess and resell that car at market value. Similarly, bondholders are entitled to whatever assets the company holds if the company ever defaults. As for disadvantages, there is always, in fact, a possibility that you could lose all of your money, as companies can always default on their bonds. Now, a way to minimize this risk is to invest in safer bonds that are higher rated by Moody's and S&P, which are like the rating agencies. And these include like US Treasury bills, which are rated AAA, which historically speaking have a 1 in 10,000 chance of defaulting. Additionally, due to the low risk mentioned earlier, bonds actually have a really low yield compared to other investments such as stocks. Historically speaking, bonds have been drastically outperformed by the S&P 500 over the past 30 years. Additionally, bonds and stocks are actually very related, which means that if a stock goes up, the bond value actually goes down, as bondholders would sell their bonds to buy more stock. Of course, this is all theoretically speaking, and it doesn't always happen in real life, but it's something to take into account. And finally, bonds are susceptible to inflation, like I mentioned earlier with the US Treasury bond, and it may actually diminish all of the interest paid if the inflation rate is high, which means you basically don't make any money off the bond or even lose money.
Okay, great. So Ronak, there was a question from the audience.
Right.
Let's go back to the previous slide for a second. So the question was, I think this is what they're saying. Which type of government bond pays the highest interest because it has a lot of risk?
Oh yeah. So that's the government bond that lasts from 20 to 30 years. I think so how I explain it is that because it lasts the longest, you are more vulnerable to the most risk, because over that time there can be like so many things that can happen. We don't know what will happen in 30 years. And because of that, it's riskier, and thus the rate is higher.
Yeah, thank you. So now this is like a really, really simplified version of the risk pyramid, because we're just going to talk about stocks, bonds, and funds for today. So you heard Colleen and Matt go into stocks, right? Which is like risky, high risk, high reward, right? And then we had Ronak and Anish go into bonds. And so you heard that those were like low risk but low reward, right? They're stable. They're probably what your parents invest in if they want you to go to college or something like that, right? I know my parents did. And then me and Gordon will be talking about funds, like the center of this pyramid. Okay, so first, there's several types of funds, but right now we're going to go into mutual funds. So this is another audience question. Anyone, why do you think that mutual funds are safer than stocks but riskier than bonds? Good guess. Yeah, managed by professionals. Which is true. Not the answer I'm looking for. Follows market trends. That's also somewhat true, especially with index funds, which we'll talk about in a second. But that's also not what I'm looking for. Same with Christopher. Same with, I might butcher your name, Karan or Karan, collection of securities. Yes, that is, I know this is like a private comment, so you guys can't see it, but I'm sorry, Karan or Karan?
Karan. Well, I mean, the first one was pretty much correct, I guess.
Karan?
Yeah.
Cool. Okay, so Karan is basically correct. He said it's a collection of securities. So we know securities to be things like stocks and bonds. So when he says a collection, it's basically like instead of just buying a single stock or a single fund or a single bond, you're buying like several of them, right? So we call this diversification, sort of, because diversification is basically, it's diversifying your collection. So you're maybe buying like some of the safer stocks, some of the riskier ones, and you're grouping them into one central fund. And so like they kind of cancel each other out in terms of risk, because like when some of them drop in value, some of them increase in value, and because of that, at the end of the day, you might not make really big gains, but you won't have really big drops either. So that's safer. Let's see. Okay, and then I see some people from the chat. Okay. So whoever said that it's managed by managers, that's correct. So what investors do is maybe like you'll have to have a certain amount of money to be able to invest in funds. So you can't too much. You can't expect to go into it with like $5 or something. You have to have a certain baseline before you kind of get like accepted and to be able to buy into these funds. And so investors will pool their money, and they'll basically have a money manager who chooses what they want to load that specific fund with. So I'll buy this stock and this bond and whatever. Okay. And then Anish talked about this before, but similarly, you make money through dividends and capital gains, which we already talked about before. So I won't go into that again. And then there's other types that we'll go into in a second with fixed income fund, equity fund, and index fund. And index fund is something that Gordon will go into right now.
Okay, guys, so index funds. All right, to figure out what an index fund is, we first have to find out what an index is. So an index is essentially how you would measure the performance of a group of options, so stocks and bonds, how you would measure the performance of those in a quantitative value. So for example, if you guys have ever been following stocks, you would know about stocks like the S&P 500. Or sorry, about if you've been following indexes lately, then you would know about indexes like the S&P 500, Nasdaq, and Dow Jones. And if any of you guys know about S&P 500, you guys would know that that's the main index that people follow. I'm sorry, who's talking right now?
Don't worry.
Sorry. So in the S&P 500, that is essentially the mathematical measurement of 500 of the largest current stocks on the stock market. So it's the quantitative, not average, the quantitative value of these 500 stocks. And usually the breakdown is around 400 stocks are industrial, around 60 are going to be for financial, and then 40 are going to be for transportation. So that's the breakdown of the S&P 500. And just to help you guys better understand it, I have a quick analogy. So say you guys have 500 different types of burgers, okay? So you have like at Wendy's you have the Baconator, at McDonald's you have the Big Mac. So these are all the different types of burgers that you can buy at different restaurants. But if we're gonna we can't figure out what's the average of the whole nation's burger prices, right? So how we're going to figure it out is we're going to take a sample of all of the entire population. So we would take 500 different burger prices, and then we would calculate the value using a quantitative average, and we would use this through bases. So you would take top burger prices, and then you would find the value from that, and then you would use that as the S&P 500, as the Dow Jones, Nasdaq, whatever you're going to do. So that's essentially what you're going to relate to, and that's how you find out if a stock is a good investment or not. You would compare that to how the index is doing. So usually when people say stuff like, oh, the stock market is up 20 points today, or it's down 10 points today, they're essentially referring to the S&P 500 and its performance that day. So if you guys say the stock market's tanking, usually you can, in North America, you can infer that they're talking about the S&P 500. And these type of indexes are really important to note, just because they're really good at calculating other economic indicators. Like you can use them to calculate interest rates, employment at different companies, and all those juicy details. And if our goal in the stock market is to do well by buying at a low price and selling at a higher price, one of the ways you can do this is through what are called index funds. And index funds are the type of mutual funds that are based off of the indexes used by these different companies. For example, you can invest in the S&P 500 index fund, which is based off the S&P 500 index. So those would be like, if you were to invest $100 into the S&P 500 index fund, you would get your $100 would be spread out throughout the 500 companies that are in the S&P 500. And the S&P 500 is really good at mirroring its index, because whatever you buy in the index fund is is basically what you're getting from the actual index itself. And index funds are usually a really, really safe bet, especially if you're just getting started in investing or you don't really know how to diversify. Just because I know Cassie was talking about before how important diversification is, just because you don't want to, like, the worst thing you could do is go in and just throw all your money at one stock, and then if it tanks, then there goes all your money, right? So S&P 500 and these other index funds are really good investments to make, and historically they perform around on average probably around 8 to 10% return every year. So even if you're going to be doing what's called passive investing, which we'll get into in our next boot camp, these are a really good way to passively invest if you don't want to get hands-on too much. So those were the index funds.
Yeah.
Okay.
And
Yeah.
just to sum up a little bit of what Gordon was saying, although I think he explained it really well, because it was really good. But basically with stocks, you're trying to beat the game. So you want to buy a certain amount and then sell higher than that, so that the remaining difference is basically the money that you get to take home at the end of the day. But with index funds, like he was saying, it's much more passive, which is actually like a formal term we'll get into later. But what you do is you just play the games, play the rules of the game really well. So it's different than stocks.
Okay, so the next thing that we're going to be talking about is the market health. So market health, generally, when people are talking about market health, it's referring to the current health, the current status of the stock market itself, and not necessarily the economy, because it's really important to remember that however, like it doesn't matter how well the stock market is doing, that doesn't necessarily reflect the health of the economy. So you can have a really well-performing stock market in a country, and the economy in that country could be doing really poorly, and and vice versa also. So there are two main types of market trends that we use to describe whether or not a stock market is doing well. So the first one is a bull market. The bull market is loosely defined as an upward market trend in prices where the prices of stocks are rising in value by roughly around 20%, or it can be more, or any value where it's approaching at least 20% increase in price. And in a bull market, not all assets necessarily go up in value. For example, like in 2020, we've had some industries like high tech. We've had energy go up in price and do really well, while other industries like oil, USO, American Airlines, so the airline industry, and other transportation industries are doing really poorly right now in the stock market. So it's really important to remember that bull market doesn't mean that everything is doing well. So currently, if you guys follow the stock market, you guys will know that the longest continuous bull market in modern history started from 2009, which was right after the 2008 Great Recession, and it ended right in early 2020, right before COVID concerns really hit the stock market. And in a bull market, the investors are really optimistic and really likely to invest just because of the overall trend is upward. Now, on the other hand, the bear market, or I know Matthew was talking about bearish companies before. The bear market is a downward market trend in which prices like stocks and bonds are sorry, not bonds, stocks are declining in value by 20%, and 20% is essentially the standard for both bull and bear markets, where we use that 20% value to determine whether or not we're in a market or not, a bear or bull market. So with that being said, can anybody tell me what market are we currently in? And you can just unmute and say it out loud.
Bull market.
Right, that's correct. I'm not sure who said that, but it is, we are currently in a bull market. Briefly this year, because of COVID, we had a really short bear market in which the prices just completely plummeted. But that was actually the shortest bear market in history, and I think it was only like 1.5 months. So that was in late February and early March. But right now we have since then the stock market has recovered, and we have surpassed the highest value of all time. So we're currently at an all-time high in the S&P 500. And bear markets are usually associated with economic recession. Of course, the stock market isn't really a good indicator for recession, so we can't rely on that completely. So in this, I don't know if you guys can see this visual, but this is essentially just a screenshot of the S&P 500 and its performance in the last year. So you can see that it was actually doing really well. We were in a really long-term bull market since 2009, and that was all the way up to early 2020, where the COVID concerns really caused prices to plummet at around the end of February and early March. And then you can see I labeled 2 points, which are red dots, and you can see that in between those 2 points are the bear market. So if you guys can see, the second red dot isn't at the actual low of the bear market, and that's because we can't put the end of the bear market at the lowest point, just because we don't know for sure whether or not that's the end. In hindsight, we can look and see that that was obviously the end of the bear market, but in the moment, it seems like it could have just been a temporary spike and it could have gone down even lower. But in hindsight, we can see that it's actually risen since then. And as of this Tuesday, the S&P 500 reached an all-time high. So we're officially out of the bear market and into a new bull market.
Yeah. And real quick, before we move on from that, I think I said this last week, but does anyone remember why it's called bear and bull? You can either motion it, or if you don't want to look stupid like I was, you could also just say it. Yeah. Thank you, Karen. Bulls push upward and bears claw downward. Oh, the other way you can remember that is obviously nobody says Wall Street. Like, you know how Wall Street, there's like a really big golden bull, and that's kind of like Colleen drew our logo. So that's kind of like our logo. Well, no one has like a Wall Street bear, and it's not like they want something bad to happen. So obviously they want a bull market. So that's something to remember as well. Okay, so for next week, we're going to have bootcamp number 2, types of investing. And then real soon after that, we're going to start forming mentor groups so we can actually review this information, maybe create presentations or projects out of that, probably have some team games, competitions, and yeah, overall have more fun with material that we have to cover first. And then at the end of the 3 bootcamp session, we're going to go have a guest speaker, the one that was the Treasurer of California, and we'll be having our stock market game. So these are the links that we would like you guys to, of course, fill out. And then for attendance, if you didn't fill that out, that'd be great, because we're going to get to that first at the next meeting. Okay. And does anyone have any questions?
Hi, where can I find like the recording of this bootcamp?
Okay, good question. Yeah. So are you on our email list right now?
I think so, yes.
Okay, so as long as you're on your email list, Gordon will be sending out an email either today or tomorrow. So either the day of or the day after every week's meeting, including all the links plus our YouTube link to where we'll upload the video. And then that's where we'll have like the majority of our videos. But we'll also have articles that kind of sum up this kind of stuff, or maybe go deeper into it, that we'll also be providing.
Okay, cool. Thank you.
No problem. Any other questions?
Yes, I have a question. Sorry. I've been monitoring the stock market, and I've been reading articles, and there's so many different views on the growth and the basically the growth of stocks. So like, who are some very well-known analysts, so I can get like high quality information?
Oh yeah, Matt, go ahead. You go first.
Yeah, so one of the most, well-renowned investors out there is Robert Shiller. He actually, early in the presentation, I talked about his online course at Yale. It's called Financial Markets at Yale.
I'm actually
Robert,
taking that.
you should definitely check out one of his online courses and what he basically talks about on current events.
Yeah, he's a really good resource, of course, because he's a professor, so he breaks down information really well for high school and college students. And the courses are free. It's also, I'm pretty sure, on Coursera, if you want to try that out. It also has like quizzes and worksheets that go along with that. And I also recommend, you could also, of course, there's a lot of websites to follow. But Rohan and I, the other day, we interviewed this one guy who's a writer for The Motley Fool. So I totally recommend The Motley Fool. It's like a really good resource. There's also other investors that we'll get into during other presentations. but they're a little bit more difficult to read. So I would start off with something simple like Matt's resource. We'll send that out in the email as well. And then probably the Motley Fool and stuff like that.
Oh, sorry. Thank you. And how do I get on the email list?
Oh, okay. For the email list, so our email, I'll type in the chat, is amateurvalleyic@gmail.com. And if any of you guys need to get on the email or you want to contact us about being a mentor, which is great because if you guys showed up and basically said anything, I think that's like showing interest. Anyway, so you guys can contact us with any questions, or if you want to just talk about stocks or be an inventor. But that's it for this meeting. And if you have any other questions, the officers and I will stick around for another 3 minutes or so. But other than that, thank you for coming, and that's the end of the meeting.
Bye. Thank you.
Thank you.
I totally forgot about street fence.
Thank you. See you guys.
Yeah, no, that's what I thought you were gonna say.
No.
Oh, shoot.
Bye.
Yeah, anyways. Yeah, I can moderate the Zoom calls in future meetings.
That's great because like I don't know what. Wait, did you guys see it when I pressed W? Did the entire screen go white?
No.
Wait, Matt saw it.
Yeah, I saw
Yeah,
it.
I don't know why. I was typing W into the chat, and then the entire screen went white, and I'm like, okay, I'm gonna stop typing on the chat. So I think in the future, that's a good plan. We should have Matt moderate the chat, and then Gordon, Colleen, and Ronak. You guys will probably alternate between sending Zoom links, and then maybe also responding to the chat. And then I usually have a waiting list, waiting room, but today I didn't have a waiting room because Colleen and I entered the meeting really early, but I thought Zoom wouldn't count that because, you know, it's 2 people, so I thought they didn't count that. I was wrong. Anyway, so next time we'll do that, and it won't be like this. But surprisingly, we didn't really run out of time because I thought this would be like a really long presentation. So that was pretty cool.
Also, should we just like answer the question in the chat so like it doesn't interrupt our flow like of presentation?
Yeah, that was a good question. I remember Derry raised his hand, and I did the thing which I don't like. Mr. Boone does this. I don't know if you guys have Boone. Wait, no. Ronak and Matt have Weaver. Colleen isn't in AP Gov Econ. Gordon's a junior. Anish isn't here, and I have Boone. So Boone, he does this thing where like he just completely stops going on his lecture, and I'll just go like, "Oh yeah," and like Anya or like some random person just had a question, and he starts answering it. I'm like, "Wait, what were you saying before?" And then the question's like totally tangential, and I just don't care. I mean, Gary's question mattered, but like in that case, I think that's a good idea. And if they have like a raising hand and it's not like a chat question, then I think what I'll do is like with Ronak, I'll try to catch the question, and then like between shifting slides, then someone can answer it. And so I think that can be Matt's job in the future. If he sees like a question in the chat, he can like alert like Ronak or Gordon or whoever's speaking at that moment of the question. But yeah, any other feedback, because that's good feedback. No? Okay, then I'll send out the second boot camp, and I'll get ready for the mentors for the 3rd meeting. And then I'll talk to Grace about the treasurer. Okay?
Thanks, guys.
Thanks, guys. Bye.
Bye.